SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF Bocconi Meet the Authors e-lecture and panel discussion. Today's theme is Money in Crisis, the Return of Instability and the Myth of Digital Cash. The development of finance and money is shaped by the combination of technological advances and the shaping of institutions. This interesting and important interplay can be observed far back in the course of history to the present day. Recently, the nature of money and the way in which we conduct payments and store and invest financial wealth appears to be in rapid flux due to the creation of digital money and digital payment systems. A just released book, Money in Crisis, explains what the digital revolution in money is, why it matters, and how its potential benefits can be realized or undermined. It explores the history, theory, and evolving technologies underlying money, and it warns us that money may be under threat from inflation, financial instability, and digital wizardry. The book also discusses how modern forms of digital money, crypto and stablecoins, CBDC, etc., fit into monetary historical patterns, and it explains the benefits and risks of recent innovations from an economic, political, social, and cultural viewpoint. We are privileged to have the two authors of Money in Crisis with us today. Ignazio Angeloni is a former top ECB official with vast experience across a wide area of responsibilities, and now a policy fellow at the Leibniz Institute for Financial Research, SAFE, and Bocconi University. Daniel Gros is the former long-standing director of the European think tank CEPS, and now the director of the Institute for European Policymaking at Bocconi University. Our two discussants are equally outstanding. Katrin Assenmacher was for many years the head of Monetary Policy Strategy Division at the ECB, and now is head of the ECB's stress test modeling division. Harold James is a world-renowned historian. He's professor of history and international affairs at Princeton University. Both Katrin and Harold, I say with pride, are also SUERF fellows. We will first have Ignazio and Daniel present their book, then Katrin and Harold will offer their comments. After this, we will enter into the discussion among all four panelists. Without further ado, over to you, Ignazio and Daniel.
Thank you very much, Ernest, for your nice introduction. I am very glad to be with you this afternoon. I'm honored to speak in front of this very numerous and very qualified audience. I thank Ernest and SUERF for organizing. So this is the book. The title is Money in Crisis. And maybe I should start explaining how we got interested in this subject. I've been dealing with monetary issues more or less for the whole of my professional life. But for many, many years, I was not really interested in the payment system. You know, in the early days, money was the money stock, money demand, money supply, and the implication of that. So we were not really interested in the little transaction that ordinary people do every day. But this has changed in the last few years, and now there is a huge interest in the payment system and its implications. The whole thing, I think, started with the application of the internet to the payment system, the digital application on the payment system. But it came as a shock to many people, including us, in 2019. When a big tech company, Facebook, announced that they wanted to launch a global currency issued by them using their digital technology. So that would have been a situation in which a big tech, a private company, would become the central bank of the world. That was the initial intention. Now that failed for a number of reasons. I mean, the design was not very good. But shortly after came the Bitcoin boom. I mean, Bitcoin was older. The original proposal was 2013, but the first big boom of the Bitcoin was 2021 and continuing. And right after that, the central banks thought that they should enter into the digital payment market themselves, partly to occupy a space that was rapidly being occupied by the private sector. So I call it here the CBDC frenzy, meaning that many central banks decided to undertake studies and research on the possibility of introducing their own digital currency. Now, this has largely faded now. A number of central banks have announced, starting with the Federal Reserve, have announced that they are not going to issue a CBDC. The ECB is still engaged in this project, and the People's Bank of China has already implemented this proposal. So the situation is mixed in that respect. Now, shortly after came the stablecoin twist. I call it twist because this is a spin-off of the crypto world. In a sense, it's a strange instrument because it's not a speculative instrument. You cannot make money in principle with a stable coin, but it's supposed to be, precisely because of its stability, supposed potentially to take the role of money as a payment instrument. And then, of course, all the politics behind it. I mean, we've seen in the US election last year, the Trump campaign that used the crypto world to conduct a campaign and have political advantage. So the whole thing came as an interesting to us. First question, why all this fuss about money? I mean, are we going too far in the sense, talking about money and different forms of payments all the time? But then the serious questions are, first of all, how do modern digital monies relate to what money is about and what has been about historically, analytically, theoretically, and also socially. Socially, because money is a social construct, is an instrument that helps conduct social interactions. And so from all these points of view, what are the implications of digital monies? And then this is a positive question. Then a normative question, how do they relate to what money should be about? And we thought we should start with history. So as soon as we started with history, we stumbled into this very interesting example. I mean, many people are familiar with the history of Mesopotamia. The monetary history of Mesopotamia is particularly interesting. So this is in many ways, it's a paradigmatic case. So the fundamental value for the ancient Mesopotamian laid in barley and silver. You can see the barley and the silver down there. And the fundamental value was stored in the temple, guarded by priests. So the priests were the guardians of value, and outside of the temple, value would circulate in the form of clay tablets. You see one on the right. The clay tablets on which a number of things were written, including the value, the conditions, etc. And so that was a system in which combined total security under the guardianship of the priests, security and safety on the fundamental value, where it was stored and how much there was in the temple, and flexibility outside of the temple, in the sense that the tables would circulate, the clay tables the tablets would circulate. Also the use of technology, because the Mesopotamian had a very state-of-the-art technology for producing tablets. And so there was a combination of the private sector, quote unquote, the merchants outside of the temple producing the tablets and circulating them, and the public sector, religious power in this particular case, the priests in the temple. So one can formulate, we have this hypothesis in the book, which is the success of money relies on a balance between the public and the private component. The public component ensures the safeguard of the collective interest. So precisely because money is a social construct and supporting social interactions. And the private element ensures that the state-of-the-art technology is applied and cost effectiveness in the production of monetary instruments through competition. So the combination and the balance of these two elements. Now it turns out, if you look at history after that this pattern repeats itself, technology and money, and in the different epochs. So Babylon, the clay tablets, Sardis, which was the capital of Lydia, where coinage was invented and then transferred into the ancient Greece and Rome, metal coins, and eventually paper banknotes in China, in the Middle Age China. By the way, coins are the most successful payment means ever. They were introduced the first time in the 6th century BC, and they are still around. So there's no other means of payment which has been as successful as coins in history. By the way, do you know why coins are round? If you want to know it, read the book. I'm not going to tell you now. Please read the book. The balance was maintained in the case of the ancient Babylonians, as I said, by the combination of the work of the priests and the merchants. The balance was lost in the two successive civilizations. In late Rome, as we know, there was a debasement in the 3rd century, and the money lost value because of the excessive power of the emperor relative to the market equilibrium. And the same in China, after the banknotes were invented, the Chinese kings produced too many banknotes, so overprinting, producing hyperinflation. So this is probably the most thoroughly investigated case of monetary debasement. The case of Rome lost between the 161 and 305 AD, lost large part of its value. By the way, if you make the calculation year by year, the loss of value per year is less than 2%. So less than the target, the inflation target of most central banks, including the European Central Bank. It's interesting. Now, the debasement of the Roman coin is considered one of the causes of the fall of Rome. So that was actually less than what's happening now. We have a long chapter on the golden era of central banking, and it's a long stretch of time. So from the 1920s, right after the creation of the Federal Reserve, to the 2000s, so the eve of the internet era. So during this period, we call it the golden era of central banking because the balance between the public and the private was particularly strong in that period. Now, experimentation and innovation in the payment system was left exclusively to the private sector. There was an increasing and massive application of telecommunication and digital technology to the payment system, and the central banks were providing the bedrock. The bedrock, in particular, through central settlement and payment oversight, which guaranteed the security of the monetary means and the monetary system. The banknote production was the basic service, producing the banknotes and ensuring the convertibility before at the beginning into gold and then in the end into banknotes, whose value was guaranteed by the independence of the central bank and the inflation targets. So there was this balance between the central bank providing the foundation of the system and the private sector providing the technology and the innovation component. The balance was there until 2000 at least. Now the question is, are we losing that balance? So this is my last slide, and we look at, from this lens, whether the balance is lost. We look at central bank digital currencies, and then we look at Bitcoin and stable coins. Now, when we talk about central bank digital currency now, we really talk about the digital euro. Because as I mentioned, a number of other central banks have either decided not to produce a CBDC or they have suspended their studies. So it's really the ECB that is very much engaged still in the production of a CBDC, the digital euro. Now we take the view, we argue in the book, there's a specific chapter on this, that the ECB, by settling private payments instead of the private banks, would compete with the payment system providers, which the central bank itself oversees. So there's a conflict of interest between the participation and competition of the central bank in that market and the fact that the central bank oversees that market. It would produce its own payment applications, they are working on it, and that I think risks discouraging private competition in innovation, and it risks disintermediating the banking sector. If many people shift their funds from bank deposits, so deposits at private banks, to the central bank, risking, if the shift is massive, risking a credit contraction, or if the digital euro is not so successful, risking a reputational loss. Now, there is a lot of discussion about the limit that the digital euro portfolio may have, the digital euro. So there's been discussion about 3,000 euro, less than that, more than that. But the risk is that the opposite risk is a credit contraction if there is an excess disintermediation, or a reputational loss. Now, at the same time, a number of alternatives are being developed. There's FedNow in the United States. I've tried it. It doesn't work very well yet, but still, I mean, this is something that the Fed has been developing in the last few years. In Europe, there is a project called Vero, which is a joint venture of a number of banks. That also is not yet working very well. I've tried it myself. There are lots of French banks in it, very few German banks, so it's not yet fully developed. But that's and the key target of Vero is to have intraday transfer across borders, which is something that in the instant payments presently existing in the banking system does not exist. So that's work in progress. There is stable coins, which are exploding, as we know, and there's more to come. So we make the point in the book, and here I conclude, we make the point that the ECB should revisit the digital euro project as a retail instrument, and should instead focus more on improving the wholesale cross-border payments. That's an area where digital instruments can really make a difference. Now I pass the baton to Daniel.
To take up the baton where Ignazio left it, namely, is the balance endangered by CBDCs, and whether actually then crypto would tilt the balance excessively in the other direction. And here, just to make sure that we are all on the same page, CBDC works on a traditional ledger, because the very point is to have an account with the central bank directly. So you don't need a distributed ledger, you just need one ledger, namely that of the central bank. But a crypto was born actually to make, if you want, central banks not obsolete, but irrelevant. In 2008, we had the financial crisis. And then what came about was this dream of the original creator of the Bitcoin to have a payment system without intermediaries, without banks. Although then the subsequent evolution will be very different, as you will see. And the proposal was that you could have a peer-to-peer payment system that would use a new software technology, in which the simple idea was that all transactions that the people on this network would have would be bunched in blocks of transactions, and that these blocks would be stored on many different computers worldwide, all computers connected to the internet, and each additional block would come on top of the others, so they'd have what's called a blockchain. So one followed the other. But I think it's better to look a little bit below the hood to understand crypto, how does it work? As I said, it was supposed to be a peer-to-peer payment system without intermediaries, and an additional point, selling point was it was irreversible. Because if you have this chain of blocks and you have recorded all past transactions, then you cannot really change any previous transaction. And the key, if you want, novelty of this blockchain technology is the question, how do you verify that the transactions which people have put into the system are actually acceptable, that they can be verified. And the way to do so is to distribute the verification of the transaction or of blocks of transactions among all participants. And the simple rule of decision is that when a majority of the participants in this network, so-called nodes, agree that the transaction in the block is legitimate, then it is taken to be part of the blockchain history and is accepted. So there's no need for a so-called trusted intermediary like the central bank or banks. And finally, as I said, it's a so-called permissionless blockchain, in the sense that anybody can just open a wallet. It's peer-to-peer, but in reality, when you look how you do that and how you operate it, it is not really for everybody. You have to be, let's say, somewhat computer savvy to do it. I would not trust myself to do it without help. So that is the first point. It was meant to be irreversible and without intermediaries, but if you cannot de facto use Bitcoin without intermediaries. And I would bet that 99% of all people in the world who have invested in Bitcoin have done that through intermediaries like exchanges and so on. Just to give you an idea of how a Bitcoin transaction looks like, I wanted just to show you here the very first Bitcoin transaction. And that was a transfer of 50 BTC, 50 Bitcoins, from the wallet, which you see there, no name, just 32 alphanumerical elements. These 50, they go 10 to the one wallet you see in the output. Again, a very long string of alphanumerical characters. And 40 go actually back into the input, which you see on the left-hand side. So that's the particularity of every Bitcoin transaction, which is that if I have 100,000 and I want to send one to somebody, I have to write here is one to somebody and 99,999 to myself. Now, what the entire world can see is this, what you see right now, this screen. So you can see how the balance of each wallet evolves over time. It is just that you don't know who is behind the wallet. And that's what's called pseudonymity. Of course, if when the anonymous founder of Bitcoin, he actually announced that he sent 10 Bitcoins to the person who to help him program it. And that person, so the person who received these 10 Bitcoins, he or she then knew how much Bitcoins the inventor had at that point in time. And it could follow in principle the balance on the Bitcoin wallet of the inventor forever. You can still do it today. If you were to copy and paste these things and put them into a Bitcoin tracker, you can see how this wallet developed over time. So in principle, all the transactions can be followed. Now, what people do de facto is, especially illicit ones, they send 10 to a friend and 40 to themselves, and then from 40 to themselves to a different wallet that nobody knows. So that's how they can escape and become anonymous as well, and maybe not only to one, but to 100,000 different electronically created ones. And that's what the scammers do when they get Bitcoin from a company on which they got a payment. They then put it in so-called tumblers, and the money goes into 100,000 different wallets to preserve the pseudonymity. But in principle, with enough computing power, you can see whoever has received the money you sent somebody and where it then subsequently went. So as I said earlier, the basic principle of crypto is the wisdom of the crowd. But if the majority agrees of thousands and thousands of people, then you can assume that the transactions they validate are true. But the key thing is how to incentivize participation in this verification mechanism. And here there are two ways. One is called proof of work in Bitcoin, where you have to solve a difficult mathematical problem, one that involves a lot of computing power and a lot of energy to mine the next block. And if you do that, you get actually, right now you would get 3 Bitcoins, so $300,000 as a prize for having done this work. And then you have another way, which is proof of stake, whereby you have to have a majority not of everybody who participates as a miner, but everybody who has immobilized a certain amount of coins, of these Bitcoins or Ethereum coins, to participate in validation and obtain a reward. Now, in principle, this should be the same or similar in the sense of always harnessing the wisdom of the crowds. De facto, what we have seen is that the stakes are more and more concentrated so that you can have a small group of stakeholders getting together, having 51% of the vote, so to speak. And then what they could do is they could put in one new transaction, giving them lots of coins, validating themselves, and thereby what's called a 51% attack could be very rich. For the time being, this is just theoretical for Ethereum, but it has happened on other blockchains where a 51% attack basically has put in a transaction to himself, and then having had enough voting power, was able to get that transaction validated. But what is happening de facto with proof of stake is that we have a return to trusted intermediaries, that people basically trust the very few large institutions that basically control the majority voting. So that's the basic setup of crypto and especially of Bitcoin. Now, could that become a means of payment? Now, the key underlying problem of Bitcoin, any crypto or blockchain system, is you have transactions which are bunched in blocks, and these blocks have to be spaced over time. For Bitcoin, it's at least 10 minutes. So you cannot use Bitcoin to pay in a store because you would have to hang around for 10 minutes and sometimes much more to get verification. Moreover, since you have a maximum of 4K transactions per block, basically in the end, the Bitcoin system can only have about 7 transactions per section. And I think everybody can see that this is vastly insufficient. Credit card do thousands of times more. China, Alibaba do another order of magnitude more. And moreover, on most blockchains, the timing of each transaction is uncertain. It depends a bit on the willingness you do for speed. I've given you here the Bitcoin example. Of course, there are technical ways to go down from 10 minutes to seconds, make it quicker, but the basic problem remains. You have these blocks, and you have to wait for everybody in the network, or the majority of the network. Some computers might not be connected, others might be offline for other reasons, to verify the transaction, and that just takes time. And therefore, with the distributed ledger technology, it's not possible to have instantaneous or real-time payments. So de facto, the value of Bitcoin is not underpinned as its usual means of payment that we have for normal money, but it is usually, it is very convenient for gray transactions. Plus, of course, it's gambling allure, because for these, instantaneous payments are not important. A couple of minutes is enough if you want to send either a friend abroad if you want to make a donation to a opposition politician in Russia, for example, or just if you want to pay for some truck delivery. Let me jump over some discussion has been very important, namely the use of resources in the proof of work mechanism. It has grown to be very large and is destined only to increase if the price of Bitcoin stays so high. You can actually follow all Bitcoin transactions live if you just click on these links here, and that shows you that I don't know whether I can do it actually on screen, perhaps better not. It shows you that among the crypto coins, Bitcoin is 3/4 of the story, and all the others are just occupy niches. And the transactions and the transaction fees actually can also be followed live online. So you can, if you are a quick reader, you can see live how each transaction, each block comes up, and you can follow every single transaction, which of course is very time consuming. But with modern computers and AI, you can actually then also find out what the patterns are, and maybe then get back to the actual owner. So that is my question. If you have AI tools and more computing powers, how long the pseudonymity will actually survive on these blockchains? So the blockchains therefore have, let's say, it's called a trilemma, but actually I think the basic problem is between decentralization and scalability. If you want to have decentralizations, you want to have many thousands of nodes of participants that validate each block of transactions. But if you want to scale it, if you want to have hundreds of thousands of transactions per second, then it's an obstacle, because to get a majority among 50,000 nodes just takes some time, because you have to find enough people who are online. So I think that is one unavoidable problem of the blockchain technology. Now let me come then to what Ignazio already mentioned. What is the difference, if you want, between stable coins and crypto and CBDCs? First point, as already mentioned, CBDCs don't work on a blockchain. They work on the central bank ledger. Stable coins that operate on the blockchains, basically they hitchhike on existing blockchains like Ethereum de facto. And they are different from Bitcoin in two respects. One is, of course, that, as the name says, their value is supposed to be stable. One USD dollar is supposed to be $1. And the second point is, which reflects a bit then on the technology they're using, is they are supposed to have low transaction costs. Whereas for Bitcoin, the transaction costs are necessarily high, because you have these very high costs that have to go to the miners that I mentioned earlier. So in a sense, stable coins work only via intermediaries, namely the issuer that issues one of the stablecoin unit against €1 and gives you a promise that whenever you want in the future, you can exchange the stablecoin back into euros. And that's why we are saying in the book that basically issue of a stablecoin looks like a bank, or you could argue also like a money market fund that we have in the future. I will not talk about the so-called algorithmic stablecoins, where the value was not underpinned by holdings of valuable assets, but just on algorithms, because they have already failed as a business model. So what is new and attractive of stablecoins, and what are their drawbacks? First of all, I would argue that stablecoins inherently retain the problem of the speed of transaction that you have in any digital ledger technology. Discrete intervals between blocks, you have often congestion on the internet, and the time needed to reach majority of validators. So I would be very skeptical anybody claiming that stablecoins can use as a mass payments, real-time payment system. And of course, what is similar to the stablecoins is that you can see every single transaction on the blockchain, on the Etherscan, for example, website here. Basically, Ethereum is most often used, and here the speed is again variable, but like for Bitcoin, often 10 minutes and more, but sometimes also less. So therefore, the question, are stablecoin money, or why would actually anybody hold stablecoins? So as Ignazio used to say, stablecoins promise €1 for €1, but you have already euros, right? So what's new about it? Moreover, on stablecoins, you cannot get any interest. That's prohibition. That's prohibited by regulation. So what is what are the two main use cases of stablecoins? First of all, you can use it to park liquidity in the crypto space. Imagine you are a speculator in Bitcoin. You take your dollars or euros, you buy Bitcoin by an exchange, that's called on-ramp. And then you have make a loss or a profit, you go back and want to exchange the Bitcoin again for dollars. Then again, you have the off-ramp costs, they're pretty high. But you can exchange at very little cost the Bitcoins for the stablecoin, USDT. And you avoid these costs. So it's a very useful for those who stay within the crypto space. Somebody at the BS has called this, they are self-referential to the crypto space. And of course, stable coins are also a way to transfer large amounts cross-border 24/7, relatively quickly, certainly quicker than across correspondent bankings. And you can do that without any anti-money control. And therefore, again, whereas Bitcoin represents a way to transfer funds also very quickly, you're never sure what the value will be at the end because the value changes very quickly. With stable coins, you don't have this problem. Therefore, my question would be whether stable coins can really become mainstream. And finally, there's of course the incentive issue facing stable coins. You get all these funds by issuing stable coins. Regulation says you have to put them into very liquid assets, high quality assets, and they usually yield low interest. So you have constantly an interest or an incentive to go towards less liquid assets that yield, or more risky assets that promise a higher yield. But of course, if you do that then, and if you make losses on your investment as an issuer, then you expose yourself to the risk of runs. And that's why stable coins could become very unstable unless they're extremely tightly supervised. Until now, most one-to-one pegs have held, but never perfectly. And I hand over now finally to Ignazio, again, who has prepared a very nice a comparison between the US Genius Act and the European MiCA.
Yes, no, I'm closing very quickly. So we took one comparison produced by a private consultant. We put it down, and we have a scorecard. We want to compare Genius, which is the regulation of the stable coins in the US, and MiCA, which is the regulation in Europe. And we have a little tentative scorecard on the number of things. I mean, they both have some prudential requirements. So the fact that there has to be a full backing into a liquid instruments on the asset side, to make sure that stable coins can be redeemed. So both have this type of provision. My sense is that the Genius is a little bit more strict in this respect. On the other hand, MiCA is a little bit less transparent in the way it defines and in the way it describes the instruments. They don't even call it stable coins, so people may be confused. What the hell is this? They have strange denominations. But anyway, that's very typical, but that's not so important. So we have a scorecard. There is a little advantage in my view for Genius relative to, you can take a look and you can form your views. One big problem of Genius, which we don't have in Europe, one big problem is that most of the supervision on the stablecoin issues would be state supervision, not federal supervision. Only when the stablecoin issuer gets bigger than 10 million, it becomes federally supervised. And that's a large amount. And we all know that the state supervision in the United States is very lax. I don't know what Harold's view is, but I mean, the supervision of the Federal Reserves and the FDIC federally, it tends to be more rigorous, more strict than the state supervision. And of course, less differentiated because, state by state, you can have big differences. All right, so this is, I think it's important to take a view on how the two legislations compare, because this is going to be a very global market. So there will be a lot of competition globally, and it's important to see how Europe fares relative to the United States.
Thank you very much, Ignazio and Daniel. Let's now hear the comments from our discussants. We start with Katrin.
Thank you, Ernest. Thank you very much for having me. Thank you also for the nice intro, and it's really an honor and pleasure to being here and to discuss this book. As a central bank employee, I have to do the disclaimer, so these are my own views and not the views of the ECB. And let me also add that I'm not part of the Digital Euro project. So with that, let me start by summarizing what the book is about. The book provides a history of money from ancient to modern times, and importantly, the role of technology. And it covers really a wide range of aspects. And as Ignazio has shown, it starts from clay tablet and it ends with digital money. And we learn a lot about crises, about monetary theory, about the role of banks, the digital transformation of payments, crypto, the global monetary system, and CBDC. And these are all very, very topics, all of them centered on money, and all of them document the profound knowledge and the experience of the authors. And I must say, at some times I was wondering how the authors would manage to get back to their main topic, but they always do, and it's always interesting and entertaining. So now the main topic. So in my view, the book is less about crises, but rather about money and how money is shaped by the evolution of technologies. So crises, the authors themselves say in the beginning, it can be read as a state of disorder, or it can be read as a point where the development turns. So it's a turning point in the development of money. And I think the latter is more true for the, characterizes the topic in the book better. But I guess, well, I think crisis always sells. So it's probably the reason why the book is not called Money and Technology, but rather Money and Crisis. So I think, however, that the book also points to the risk of new technologies. So always when there is a new technology coming up, we have risk. We have, in many instances, as the book documents, these risks materialized and led to monetary disorder. So I think it's the book documents the expertise and the practical insights of the authors. Both of them had a distinguished career in academia and public institutions, and they have earned their credentials for their contributions to monetary theory and monetary policy. And it's a must read for professionals in the financial sector and anybody who is interested in monetary theory and current developments. So overall, I really very much enjoyed reading the book. So now that said, of course, I agree with many of the points being made in the book, but I think the discussion would be less interesting if I go through a list of the topics I agree with. So I will focus my discussion mostly on those points I agree less with, and I guess the most prominent one will be the central bank digital currencies, and maybe Ernest was also thinking of that when he invited me to discuss the book. So let me start with the thesis that monetary stability is a result of a public-private partnership. And I think this idea is a very interesting way to think about monetary systems. The private part is linked to technology, which ensures that the system is working well and smoothly. And the public part is about setting the rules of the game, preserving the money, the value of money, and making sure that money benefits society as a whole. So, but I think there are fundamental challenges to both parts of this argument. And first one, on the public side, there is a political economy incentive that is involved in monetary crisis. The book provides many examples of sovereigns that are in need of funds, and then they have an incentive to debase this currency. And the book is relatively silent on the incentives that lead to these crises and how these incentives are shaped by technology. So I was wondering, is it becoming easier or is it becoming harder with the progress of technology to, for the public to, does it change these incentives for the public sector? On the private side, I think the main caveat to the argument that there is perfect competition ensuring a smooth working of the monetary system is network effects. So the more people use a specific form of means of payment, the more useful it is for the others. And this, in the end, leads to a situation where there is a winner takes all, and there is less. So one always has to make sure that competition is in fact working. And this is also related to technology. So once you have installed the rails, payment rails, then of course everybody wants to use them, and there is little space for others entering the market. So how does this boundary between the public and the private sphere depend on the technology? And what I was thinking is that, there are factors that make the job of ensuring monetary stability harder when technology advances. So one example is the dematerialization of money. So in the old times, you really had to change the content of precious metal in the coin. So now you just have to print banknotes, or even you have to just increase digital reserves. So debasing the currency is easier with dematerialization of money. Then we also have technology advancing the complexity and the speed of transactions. So I think also that is playing a disadvantage for the public sector. So it's harder for public actors to regulate appropriately the complex, increasingly complex financial system. And it's also more difficult to intervene on time to ensure financial stability. I think one prominent example is the Great Financial Crisis, where deposit flight and where the lack of understanding of what was going on and the interconnectedness of actors led to, in the end, widespread bankruptcies. Or also coordinated deposit flight by social media is also creating, less time for regulators to step in for. So in my view, both of these arguments would call for an increased role of the public sector in regulating the monetary system and having a larger role in ensuring financial stability. However, there's also an argument that goes in favor of more competition in the private sector. Consumers nowadays have much more access to information and can use more alternatives for paying and investing, and therefore this should strengthen market forces. And we saw it's easier to switch into other currencies, it's easier to go into crypto. But also this increase in alternatives comes with potential to generate bubbles, herding behavior, and so it's not clear that it's always conducive to monetary stability. So overall, I think technology tilts the balance rather towards a larger role of government in the financial sector. Then the core thesis regarding CBDC is that the engaging in CBDC issuance would go against the established balance between private and public roles in the monetary system. And here I have a quote from the book. Is said that this would be akin to nationalizing a service in which private companies so far have played the central role, and successfully so. So central banks should keep out of that business. It's not a good idea to go there. And I fully agree with the authors that setting the boundary between public and private spheres is the essence of good monetary governance. But as I argued on the previous slide, I think this boundary is not completely independent of technology. For instance, if you look at banknotes, at least in Europe, banknotes were a private invention in the beginning, but then at some point, the public sphere, the government stepped in and issued banknotes as a public means of payment. It's true, the private sector is usually much more innovative, but it also does not always ensure socially adequate outcomes. So financial inclusion is an obvious example. And nowadays, you cannot live without access to digital payments or to online payments. Another example where probably the private sector is not ensuring adequate social outcomes is monetary sovereignty or strategic autonomy and payments. These are both arguments that are key to the ECB's Digital Euro project. So from that perspective, I see central banks' endeavors to create a retail CBDC as a project that makes public money fit for a digital future rather than as an overreach into private markets. Of course, new technologies always come with risks, mistakes, learnings, but ultimately this helps to advance the efficiency of the monetary system. So final remarks. At the end of the book, the authors sketch 3 avenues for central banks in the future. One is that central banks are evolving as a bank of the state, also in light of the widespread asset purchases in the low rate period. The other one is that central banks go towards a bank for everyone, especially if they venture into the retail CBDC space. And the final avenue is bank for banks, which is more or less the current system. I think it would be interesting also to hear the author's views on how technology affects these 3 functions. So first, I don't think these are separate avenues. I think a central bank is always performing all of these functions to a varying degree. But I think it's also interesting to think about how technology affects these functions and how the central banks perform these functions. So I talked already about how technology shifts the boundary between the private and the public sphere. I think another interesting topic in that blog is how to preserve central bank independence in such a world. Bank for everyone, as I argued, retail CBDC is, I think, one way to deal with an increasing digitalization and bringing that as a legal tender to citizens. But it's also the question about how to regulate technological innovation. So Daniel talked a lot about the Genius Act and MiCA, which are, of course, attempts, but we see that with a new technology, there's always a challenge in getting a good regulation. And finally, in the bank for banks, so first is a challenge to stability from an increasing speed of transactions. So regulators, central banks have much less time to intervene if something goes wrong. And finally, which is also touched upon in the book, is the blurring lines between banks and non-banks, where technology leads to an increase of fintechs and move of fintechs into the traditional banking sector. And of course, central banks have to think about, do they stay in just working with banks, or do they allow access to the balance sheet to non-banks? So overall, I think this would probably make for a next book. So I think there are many interesting questions that are linked to the topic of the book. And I must say, I really enjoyed reading. So thanks a lot.
Thank you very much, Katrin. Let me now turn to Harold.
Well, thank you so much, Ernst. It's really wonderful, great honor being here to discuss this very important book. And like Katrin, I really enjoyed reading it. I think it's very, very important, and I will recommend it, actually make it compulsory for all my students next time I teach the course on financial history. I mean, first of all, what's beautiful about it is that it really combines history and theory through economic history, economic theory, and thinking of a very, very broad span of history, and making the point in the end that there are moments of disruption, moments of crisis. I think that's why crisis probably belongs in the title of the book, and a transition between moments when there's stability and there's then moments where there's deep instability. And it does seem to me that you are absolutely convincing in saying that since the early 2000s, or maybe since 2008, we've been living in a time of great instability. And you point out rightly that Bitcoin was developed at exactly the same time as the global financial crisis. And so in some sense, the demand for this is a feature of the way that we're obsessed with crisis and with instability, and also with the way that technology can produce innovation. The second thing I like about it is the way that you really go into the inside details of how these mechanisms work. And so you tell us exactly how Bitcoin operates, how blockchains operate, and you had that demonstrated to you in Daniel's part of the presentation. This is just wonderful, and there are so many books on this that just don't do that degree of attention and don't dismantle the process to show you exactly what's behind the hood, as you say. Or another metaphor that you use is there's one way of looking at it from above, where you think of the way that the user approaches this, and it can be easy for the user. You said you have to be a geek. Well, you don't have to be that much of a geek if you use these platforms and these wallets to do the Bitcoin technology. But you really want to understand what's behind it if you're going to think about how it's going to develop, what the chances that it holds are. The third thing I liked about it, if I might say so, was that it's remarkable for a book that's produced now that there is only one reference to Donald Trump in it. On page 259, you say that Donald Trump, his campaign in 2016, used information from Facebook via Cambridge Analytica to support his campaign. But you don't tell us who won the election. You don't tell us anything about the future of it. And actually, that's very refreshing. And I want to come back to that a little bit in the comments. So three areas where I wanted to push you a bit. One is the discussion of stablecoin. And in some way, your presentation today went obviously beyond what you've got in the book, because the book is subject to the physical constraints of publishing and it's slow. And so you couldn't really cover what Ignazio just called in the presentation the strangest twist of them all, the obsession of the US administration at the moment with stablecoin and with promoting stablecoin. And the US Treasury on its website explicitly states this. Treasury Secretary Bessent has repeatedly made the point that stablecoin he thinks of as a way of increasing the demand for US dollar securities, and in particular for Treasury securities. So it's a way of making sure that the dollar will continue to be the preeminent currency in the world. And you have then, I think, a kind of ambiguity in this, in the sense that if a stablecoin is really what it appears to be, why should you hold it rather than a dollar? And Daniel just made that point. We have stablecoins already, the US dollars, and or the euro is stable. But it's actually something else, as well as promising to be stable. One is that it's a way of getting access to the dollar for people who are excluded from the dollar by security requirements, by sanctions, by the sanctions. You described them quite nicely in the book, that are applied at first against small countries, North Korea, then against Iran, then against Russia, then possibly against China, Chinese companies that deal with Russia. So there's a whole demand for US dollars to make settlements for people who don't have official access to the dollar. And if you look at the users of Tether, until the Genius Act, it was actually impossible for US residents to work with Tether. But the people who use it are in Russia, in China, in Iran. So it's a kind of odd way of getting round part of the sanctions regime. And the second use of it that I think is dangerous and is a threat to financial stability is that the stablecoin, as you said, the Genius Act says it mustn't pay any interest. So why would you take it? Well, it can be a way, an entry point into getting into the crypto world where you can get a lot of returns. And so as a platform into the crypto world, it then holds open the possibility of getting large returns. And by the way, also, the point that Ignazio made about the Genius Act leaving things to the states is really important. Leaving regulation to the states is very important, because the states behave in very different ways. And some US states, Wyoming, has got its own stable coin and it pays interest on it. So it's a kind of remarkable thing. It seems to be at odds with the provisions of the federal legislation of the Genius Act, and doubtlessly it will be litigated. But at the moment, we have a stable coin that pays an interest in one particular state. This is, to me, a kind of fascinating area that demands more exploration. And it seems to me, if I also might just make a kind of historical analogy, it looks a bit like the enthusiasm that people had in the early 18th century after the introduction of the Bank of England in England. There was a big enthusiasm for these kind of instruments, and people did it everywhere. And John Law did it in France. And the kind of fascination of everybody that thinks that law has got an absolutely new mechanism for dealing with things and making France the financial center of the world, obviously is bitterly, bitterly disappointed in 1720, when the whole thing crashes down. But there are, I think, nice analogies between the role of the crypto enthusiasts and the tech bros in the MAGA world and the world of John Law in 1720. So let me just raise that as a historical analogy. Obviously, no historical analogy is ever precise. That was one area that I think it would be nice to have a kind of update of the book, or an appendix to the book, where you discuss the stablecoin enthusiasm of this year and the strangest twist of them all. Secondly, I was fascinated by your discussion. It didn't come up all that much in your presentation, of the traditional role of money, where you wanted to add to the way in which textbooks describe money as a store of value, a unit of account, medium of exchange. You wanted to add something extra, which I think is very important. That is that it's informationally safe and it's private. That, I think, is the core advantage of the traditional payment systems, of the way we use banknotes and coins. I wonder how much of that is at risk in the world today, and in particular, how much and how often many people are prepared to trade privacy for some kind of advantage. And you can imagine the advantages that you could possibly have by issuing money, including your new versions of money, with different levels of privacy. And in a sense, when you discuss the Chinese story, you get into this aspect, because if you think about it, if, for instance, our insurance companies would know exactly our complete pattern of expenditure, and they could see how much you spend on alcohol, or how much you spend on high sugar drinks, they might, how much you spend on tobacco, you might adjust the insurance rates. I mean, as it is already, you get better insurance rates if you're a non-smoker. But sacrificing privacy in this area could bring substantial advantages. And you will have, I think, people who have different levels of wanting to protect their privacy. And I think that's not surprising and quite natural. And you could actually allow people to surrender some of their privacy in these new forms of quasi-money. And I think you're absolutely right also in discussing the innovation as on a spectrum between traditional money and assets. And that's exactly the issue with Bitcoin that you brilliantly described. The third area that I wanted to come to is the area that was highlighted also in Katrin's last slide. When you discuss the future and you think about the issue of what the world of central banks would look like, and you have three alternatives: banks of state, banks for everyone, and banks of the bank, banks of the banks, so banks that just cater to the financial system. And Katrin described that as the traditional view of the bank. But actually, it seems to me that central banks have done all of these things for most of the time. And sometimes they've been more banks of the state. I mean, that's certainly the case with the Riksbank or the Bank of England at the beginning, or the Banque de France was constructed exactly in that way. Banks for everyone, well, they became banks for everyone in the 20th century. In the 19th century, central banks had their banknotes, but they were mostly very, very high denomination banknotes, and ordinary people didn't carry around the notes of the Bank of England or the Reichsbank. And then with 1914 and the First World War, they start to have £1 notes and £5 notes, and then everybody has them in their pocket. And so, in a sense, for the 20th century, the world in which I grew up anyway, you all had Bank of England notes in your pocket, even if you didn't necessarily have a bank account. And so the Bank of England was the bank for everybody. And, I think that's the powerful case that is behind the argument that Katrin made about the provision of central bank digital currencies. I mean, it seems to me that this is a better route to go than the stable coin world. And if you think of the stable coin obsession as being mostly US and the CBDC as mostly European, it seems to me in that context that there are substantial advantages for the European approach. And the whole discussion actually seems to me to be an echo of a discussion that took place in the 1990s when central banks were moving to independence, and they had to formulate what exactly they were and what they did. So the Bank of England, as far as I know, had really no definition of what it was about until the early 1990s. And then suddenly they had a discussion of purposes, and they said they've got three purposes. One is price stability, monetary stability. Two is financial stability. And three is to further the interests of the financial sector in the UK, to be the bank of the banks and the bank that proposed, that stood for the development of Britain as a major financial center. And then in the course of the 1990s, when it came to thinking about the wording that would actually go into the statute that created the Bank of England as an operationally independent central bank in 1997 and passed in 1998, they delete the third one, because the third one is the advantage of a particular sector, and it's not the advantage of the people as a whole. And many people historically constructed scenarios in which financial interests were opposed to those of the industrial community or opposed to those of the community at large. And so thinking about central banks, it does seem to me that in the end, they have a responsibility to be for everyone. And the task of defending the existing financial interests is not an appropriate one. And in addition to that, as Katrin concluded with as well, thinking about banks today is much too narrow, because the interest, the excitement, the developments, and the threat of instability are occurring in other areas, in the private credit market. This is just growing at a fantastic pace. In insurance, the links between insurance and private credit. And these are things that central banks in the traditional function didn't have any concern with. And in a sense, if they're going to take their financial stability responsibility seriously, which I think they should, they've really got to take that expanded view of what modern finance does. And in order to do that, I think it's not unhelpful if they read your book. So please, everybody read this book. It's great. Thank you.
Thank you very much, Harold. Let's now give Ignazio and Daniel the opportunity for immediate reactions.
Fantastic discussions. I'm very grateful to both of you, and we will have to study what you have said and hear the recording. I hope SUERF will have a recording online, because it's there's so many points. Let me just make a couple of points quick. So, first of all, I want you to know that there is an online appendix, which for convenience is stored in my website, but it's accessible, and which contains the analytics of what happens when funds move from the banking sector to the CBDC and back, and the implications in terms of disintermediation and the risk of runs, etc. This is just for the technically inclined. We couldn't put it in the book because it was too technical. But everybody who is interested in the analytics of that can take a look, and it's highlighted in my website. Perhaps can be circulated. Now, one interesting point that Katrin made, and I regret that the ECB has not used that argument more, at least from what I saw, is the idea that technology, the advance of technology, shifts the frontier between public and private. Assuming that it enlarges the scope of the private sector, so it calls for a reaction of the central bank. This is an interesting argument, I have to say, that my reaction to that is not necessarily denying the relevance, but just a reaction to it would be that the regulator would react to such a development by regulating more, or maybe more, but certainly better, and making its regulatory power adjusting to the development of technology, rather than replacing or substituting itself with the private sector. So you don't want the central bank, that's my point, would be, you don't want the central bank to steal the business of the private sector when the private sector becomes more powerful. You want the regulator to use its regulatory power. And especially you don't want your daily business to interfere or interact with your regulatory power, because that can create a conflict of interest. So this is something that I think we need to reflect on. But one has to take into account the regulatory powers as well. Now, on Harold, well, the fact that we don't mention Trump too much has something to do with the length of production of this book, because it took about almost 3 times as much as we estimated at the beginning to produce. So when we started, as I indicated in the calendar at the beginning, when we started, Trump was not yet in the firmament of global politics. But anyway, 2 points that Harold made. The important question, which is now hotly debated, whether the stable coin will increase the demand for treasuries. This is a big, and then the U.S. Treasury is making this point, but I think it's a little bit of a fallacy, because stable coins are intermediaries. They have assets and liabilities. So in order to increase the demand for treasury, you have to assume somehow that the propensity of the stablecoin issuer to buy treasury is greater than the propensity of the stablecoin holders to hold treasury, because otherwise there's no, it's just, it's inside funds, it's not outside funds. So that's a question mark, and we will have to see. It could be yes or it could be no. Depends on how the different parties behave. The point about privacy is of course very important. But the point I would like to make is that neither of the three instruments that we discussed, neither the CBDC, nor the stablecoins, nor the Bitcoin guarantee complete privacy. I mean, they do promise privacy, including the ECB. The ECB is promising that the CBDC it issues will be private, but they cannot guarantee that, because as soon as the state pretends to have access to certain information, the ECB will deliver that information. There's no question about that. And that's true for the Bitcoin, which has already been accessed by the FBI in the United States and elsewhere. Information is accessible, and the stable coins, which also are run on blockchain, so the technology is the same. Now, I'm conclude with a comment on the last point that Harold made, and I think we are vulnerable to that. The question of the central bank being or having to be the bank of everyone. It may be that we didn't explain ourselves very well in that point. I mean, it's true. It's important in general, and it's politically important to make the central bank the bank of everyone in a substantive sense. The point that we wanted to make is that the central bank should not be the bank of everyone in terms of doing the day-to-day business for everyone. But I do recognize that the way we put it in the last chapter may be a little bit misleading. I leave it to that.
Thank you, Ignazio. Daniel, what do you want to add?
Difficult to add. I just can add, however, my thanks really for these great comments, both of them. Really issues, as Ignazio already said, that we have to think about. Let me telegraphically just deal with three issues. One came up in the chat when I spoke about people, if you have a 51% attack on a cryptocurrency, it's not about stealing. What it's called is you can spend your own euros, your own coins twice, right? So I misspoke in that. I stand guilty of this doing not. And it's also true that you can have complicated technical so-called layer 2 top-ups of the original digital ledger, which makes it quicker and perhaps more suitable for real money. But again, then but basically the base on which you're operating is not useful for real-time transactions that you have to acknowledge. On the digital euro, let me just add one observation, very terre-à-terre. My concern is who wants to hold it? Just, I mean, I cannot myself imagine needing one, right? Already have cash or whatever bank account balances, and they're, in my view, in my feeling, as secure as anything I would have with the ECB. And then I always come back to the example of China. They have they have a central bank currency. They have had it for 2 or 3 years. The Central Bank of China, PBOC, has heavily pushed it, and still nobody's using it. Why? Again, because why do you need it, right? The systems that we have are quite sufficient. And finally, let me add to one thing that Ignazio already mentioned. Is it actually true that the Treasury or the US government would gain by a widespread adoption of stable coins in US dollar. And Ignazio already mentioned this general problem that you don't know whether the people who actually go from something else into stable coins have a higher or lower propensity to hold treasuries. I would go even beyond that. To the extent that stable coins substitute for cash, basically the US government loses seniority because on cash it pays 0 on the dollar notes, whereas on the US treasuries it pays something, maybe less than on long term, right? But to the extent that people use these stable coins instead of cash, I think there's a loss for the treasury. Let's say if you want a more specific configuration of the general problem that Ignazio mentioned, and I think one should keep that very much in mind when looking at the potential fiscal benefit of stable coins for the US government. Thanks a lot.
Thank you, Daniel. So we have a lot of questions in the chat. I'm sure we will not be able to deal with all of them. Still, I want to give Katrin and Harold the opportunity for immediate short reactions.
Yeah, thanks a lot. So, and Ignazio, yes, I fully agree with your argument that regulation is a substitute or can be a substitute for a CBDC. So I have a paper together with ECB co-authors where we look briefly at that. And I think one proponent of having a control on circulating currency instead of regulating is Gary Gorton and co-authors. So there are arguments, so I won't repeat them here. So, but I think you cannot substitute fully with regulation for control of the currency. And the other thing is, yeah, Daniel, yes, I think the ECB is at the forefront of CBDC issuing central banks. Half of the people you're talking to are concerned that there will be too much demand for a CBDC. The other half is concerned that there will be too little demand for a digital euro. So I guess it's hard to answer this question in an authoritative way with just discussing arguments. But I think the euro area is a special entity. And I think there are special arguments that can call for a CBDC in the euro area, namely that not all people in the euro area have the same access to cross-border digital payment services that in an equal way, which is of course of concern for the ECB. Thanks.
Thank you, Katrin. Harold, further direct comments?
I mean, just very briefly, yes, I think Ignazio's point on the demand for US treasuries has a kind of accuracy about it if you just think of US residents. So, I can easily buy US treasuries, but it doesn't apply to the people who, at the moment at least, are the big holders of tether. They're not in the United States, they're outside. And so it's easier for them to get US treasuries. And that, I think, is the point of the Scott Bessent's line. It's going to make the US dollar the currency of the world because it creates the stable coin as an intermediary for people who want to hold US treasuries. And the second point, just to sort of, I think I agree with Katrin very much on this, that, for maybe upper middle income people, there's probably not much advantage in having the digital euro. It doesn't do very much for them. But it's really an argument about inclusion, and it's an argument about having banking services for the unbanked. And that is obviously technically quite complex. But I think exactly the mobile phone revolution that you talked about, it's also simultaneous with the financial crisis. But you think about where it's really been influential, it's in poorer countries. So M-Pesa was developed in Kenya at about the same time as the global financial crisis. And it's tremendously important because most people didn't have bank accounts, and they do get the mobile phones, and they can do things on their mobile phones that they couldn't do elsewhere. So in the sense of being a bank for the people, bank for everyone. This is also one of the really, I think, attractive areas of the CBDC discussion.
Thank you very much. We have virtually exhausted our time. I have gone through the chat comments, and I have seen that meanwhile some speakers have already started engaging with the people posing questions. Most of the questions actually circle around CBDC with different views, pro and con, which have already been reflected, I think, to a fair amount during this discussion here. There are some quite technical points regarding cryptocurrencies. So I think all that remains to do for me is to take away that, as intended by a good book, it can trigger an interesting discussion. It triggers new thinking. And this is actually what you want to achieve with it. And I mean, after having read this book, I can say that the presentations here today, while super interesting and to the point, did not do in any way justice to the full content of the book. So I can only encourage participants to have a closer look by getting the book and reading it. It's really very, very interesting and very well structured, and also the argument is built very nicely. Although, as you saw today, you can still, despite this very logical build-up of the argument, you can still hold against it and find many counter-arguments, be it in the area of CBDC, be it in the area of crypto, and some other aspects that were mentioned today. Let me conclude by thanking our speakers, Ignazio, Daniel, and the two discussants, Katrin and Harold, for your excellent points and for the open discussion. And let me also thank all participants for your interest in this theme and in this seminar, for your many questions that you put. As I said, I will pass them on to the speakers. And with this, I conclude this SUERF Bocconi e-lecture on Money in Crisis, the Return of Instability and the Myth of Digital Cash. Thanks to all. Bye-bye. And take care.
Thank you.
Thanks a lot.
Thank you. Bye-bye.
Bye-bye.